Hey everyone, in today's video we're covering everything you need to know about the Health Savings Account, or HSA. We'll discuss how an HSA works, the tax benefits, contribution limits, and I'll walk you through strategies for using one, so you can fit an HSA into your personal financial plan. And by the end, I'll answer two key questions. Should you actually use an HSA to invest in the stock market? And how can you unlock the money for something that's not a qualified medical expense to essentially turn it into a retirement account on steroids? So let's dive right in. A health savings account is a special kind of savings account that lets you set aside money tax-free, and you can use that money to pay for qualified medical expenses. These qualified expenses include things like doctor visits, prescriptions, dental care, and vision care. Basically, the health expenses you pay out of pocket. But not everyone can open or contribute to an HSA, so here are the eligibility requirements. First, you must be covered by a high deductible health plan, also called an HDHP, on the first day of the month. Next, you can't be enrolled in Medicare or covered by another health plan, like a flexible spending account or a health reimbursement arrangement account. And third, you can't be claimed as a dependent on someone else's tax return. Each year, the IRS publishes what they consider a high deductible healthcare plan. Now let's talk about how contributions work and the tax benefits that make HSAs so attractive. There are two main ways that HSA contributions are treated for tax purposes. First, if your contributions are taken directly from your paycheck, then they're automatically excluded from your taxable income. But alternatively, if you make contributions on your own, outside of work, then they're tax deductible, even if you don't itemize deductions. But either way, it doesn't hit your taxable income. For 2025, the maximum contribution is $4,300 for self-only coverage and $8,300 for family coverage. If you're 55 or older, you can add an extra $1,000 to these amounts as a catch-up contribution. But the real question is, can you muster setting aside this higher amount? If you're not eligible for the full year, your limit is reduced proportionally. And once you enroll in Medicare, you can no longer contribute to an HSA. You'll report your contributions each year on IRS Form 8889. Withdrawals or distributions from this HSA are tax-free, as long as they're used for qualified medical expenses that occur during your coverage period. Now let's talk about the downsides of an HSA. When you're using an HSA, you have to follow IRS rules carefully. If you take the money out for non-medical expenses before the age of 65, you'll owe income tax on that amount plus a 20% penalty. Ouch. In that case, you'd actually be better off not having used an HSA at all. As a personal tip, I actually recommend using Fidelity for your HSA provider. They don't charge monthly fees, and they don't require you to have $1,000 in your account before they let you start investing. And as long as you're eligible for one HSA account, you're free to open another one at a provider of your choosing. So as long as you stay under the total annual contribution limits, feel free to switch providers as you see fit. Now I'd like to make one important clarification about HSAs. They're not the same as flexible spending accounts, or FSAs. With an FSA, you've probably heard the term use it or lose it. That means you have to spend all the money by the end of the year or it's gone. But luckily with an HSA, your money rolls over year after year, allowing you to build cash for future medical expenses or retirement, as we'll discuss soon. Next, let's talk about one of the most powerful features of an HSA, investing inside of it. You can start investing your HSA funds in mutual funds, ETFs, or other options, just like you would in a regular brokerage account. And here's the advantage of doing so. Your investments can grow tax-free, and as long as you eventually use that money for qualified medical expenses, you'll never pay taxes on that growth. That's what makes the HSA such a powerful account. It offers triple tax advantages. Contributions are tax-free, growth is tax-free, and qualified withdrawals are tax-free. Now let's take this a step further with a more advanced HSA strategy. I call this method the pay for medical expenses out of pocket from a non-HSA account, save your receipts, and reimburse yourself from your HSA later strategy. The key to this strategy is that there's no time limit on when your medical expenses expire for reimbursement. So for example, if you have the extra cash flow in a non-HSA account, you can use those funds to pay for today's medical expenses and leave your HSA funds invested for compound growth. Then later on, say 20 or 30 years later, you can reimburse yourself for those old medical expenses and pocket the difference from all your investment gains. Now this strategy does take some discipline and organization, as you'll need to store those receipts and keep good records, but for advanced users, it's one of the most tax-efficient ways to build wealth. Now before we get too excited about this strategy of keeping our HSA money invested and saving the receipts, One quick word of caution is that tax laws can change at any time. HSAs exist today because of current IRS rules, and while those rules have been relatively consistent, future legislation could alter how HSAs are taxed, what qualifies as a medical expense, or how those reimbursements are treated. So if you're saving receipts to reimburse yourself decades later, there's a bit of a risk involved. You're essentially betting that today's tax advantages will still exist in the future. That doesn't mean you shouldn't use this strategy, but if you're going to do so, I suggest following these tips. 1. Keep accurate records. 2. Review your HSA plan often. And 3. Try to stay informed about any IRS or legislative updates that might affect HSAs. Think of it this way. An HSA can be an amazing long-term tool, but it works best when you adapt to the rules and stay informed as the tax landscape changes. So which approach is best? Should you use your HSA to pay expenses as you go, or should you invest the money and reimburse yourself later? It really depends on your financial situation, risk tolerance, and cash flow. If you need extra help covering medical expenses now, using HSA funds directly can be a smart and simple move. But if you can afford to pay out of pocket and let your HSA investments grow, then the potential long-term growth could be substantial. Either way, understanding how HSAs work puts you in control and helps you make the best decision for your personal situation. Alright, last but certainly not least, let's talk about how you can use your HSA funds even if it's not for medical expenses, which essentially converts your HSA to a traditional IRA or 401k on steroids. Once you hit age 65, the rules around your HSA loosen up quite a bit. At that point, you can take money out of your HSA for any reason without incurring a penalty. Now there is a catch. If you use the money for something that's not a qualified medical expense, you'll still owe regular income tax on it. But here's the cool part. That makes your HSA work kind of like a traditional IRA or traditional 401k in retirement. You've already gotten the tax deduction when you contributed. Your money grew tax-free, and now you're just paying tax one time on those distributions. And unlike a traditional IRA, your HSA doesn't have required minimum distributions or RMDs. That means you can just let it keep growing as long as you want and tap into it whenever you need it. So in summary, if you use your HSA at any time for qualified medical expenses, it offers triple tax advantages. But if you wait until after the age of 65 and use it for non-qualified expenses, it still offers the same double tax advantages that a traditional IRA or 401k offer as well. That's why I call the HSA a retirement account on steroids. So there's the full picture of the health savings account. How it works, who qualifies, the tax benefits, and how you can use it strategically, whether to cover expenses now or to build long-term tax-free wealth. If you found this video deserving, don't forget to give it a thumbs up and subscribe for more personal finance videos. Thanks for watching, and I'll see you in the next one. Take care.